Our crystal ball is broken, so instead we rely on income-based portfolio management. Let me explain why. I've been getting some calls lately with the current economic environment about, hey, are we too aggressive on our portfolio? Do we need to bring it back down? Or what's going on in the market today, Mike? What do we need to do? What do we need to change? And my response generally is, well, we've already done the work on your portfolio because we have selected an asset allocation that's appropriate to you based on what your income needs are. There's also a rule of thumb out there, a way of thinking that if you're approaching retirement or in retirement, you need to be a lot more conservative. Well, that may or may not be true. It all comes down to how much income your portfolio needs to produce for you. With that in mind, I'm going to share a little bit of math, a little bit of explanation on how to run a portfolio with an income-based portfolio management way of doing things. With this example, I'm going to use a $1 million portfolio, which I'm doing purely to make the math easier. And you can divide it, you can right size it for any scenario, but the principles apply. The other assumption I'm going to make is that the income need is $80,000 a year in retirement. Now, most of the time, some people need $80,000, some need less. But what we're going to have often is a Social Security payout, and this is for a dual income household. Let's assume they each get $30,000 a year. Both spouses get $30,000 a year. So what we need is not $80,000, but we need to produce $20,000 a year of income. With this in mind, having $20,000 a year of income come from your portfolio, where's that money going to come from best? Well, the bond portion of your portfolio is the best income producing part for many portfolios. Occasionally, if you have enough wealth, stock dividends work well and can satisfy this amount of money if it works for you. But generally speaking, let's just call it a bond allocation. And for this $20,000 of income, what we want to do is accommodate market cycles. So the market's going to go up, it's going to go down, it's going to fluctuate. There's an equity portion or the stock portion of your portfolio that is going to fluctuate more than the bond side. So the bond is your stability side, and that's the part where we build it out so that you have an appropriate amount of stable portfolio that can produce income. So when the market goes diving down, it shouldn't keep you up at night because we've already planned ahead for that. So it can produce enough income. In this example, to keep the math easy, I'm going to say 10 years. Generally, we look at a 5 to 7 year buffer above and beyond what your emergency fund or your cash holdings would be. So in this case, 20,000 times 10, we need $200,000. And the traditional thinking with portfolio allocation is if you're nearing retirement, you need 40%. That might actually cost you quite a bit of money. That is because 40% is $400,000. In this example, you only need $200,000 or 20%. So the traditional portfolio management theory would say, well, 20%, that's aggressive, but we're in retirement, we need stability. But you need stability that fits you. That's really the point. And what that traditional thinking would cost you is 400,000 minus the 200,000, that's $200,000. What's the impact of 200,000 extra dollars in bonds over the course of retirement? Let's just say it's only 20 years. Likely it'll be more, and you'll have growth on your growth. But if we take $200,000 and we consider, let's assume a bond return is 3%, stock return is 7%, that leaves you 4% extra growth on $200,000, which is $8,000 a year. And if we do that for 20 years, that's $160,000 extra dollars in your pocket over the course of 20 years in retirement. So this traditional thinking that doesn't account for your income needs can potentially cost you quite a bit of money in retirement. In this scenario, it's $160,000. If you're dealing with a $500,000 portfolio or whatever, you can right size it. But that's a significant amount of money to give up just by not allowing your portfolio to accept the kind of risk that it can for you to get that long-term growth. I'm Mike Proctor with Leading Edge Financial Planning. If you'd like to get your portfolio reviewed and make sure it's tuned up to your needs, just give us a ring or schedule in the link below.